Welcome, everyone. We are launching the webinar today about the opportunity for Utah companies to engage with the London Stock Exchange. We've got several people logging in as I'm speaking, so I wanted to do a quick introduction and we'll get started. This webinar today came about as a result of my conversation with James McCullough, who's CEO of Renalytix AI, a Utah-based company. And we are thrilled to have on the call today representatives from Stifel and others who will address the topic today of how Utah companies could consider going public using the London Stock Exchange, and particularly how that could maybe be a primary strategy as opposed to an exit type strategy. There are some really exciting things that I've learned as someone who's been in the business for decades, and now seeing that there are other opportunities that I was never aware of. We felt it was important to make this knowledge available to our members. So we appreciate having many of you on the call today, and I know we had several who indicated they would not be able to join, but were anxious to see the recording. So with that, I'm going to turn the time over to Nicholas Moore, who is with Stifel, and will allow our guests to introduce themselves. So Nick, take it away.
Well, thank you very much for that warm welcome, Kelvin. Pleasure being here with you all today. So let me just bring up a few pages here, just in terms of introductions. So myself, I'm a managing director in the healthcare investment banking team here at Stifel, based in London, but very much with a transatlantic mandate in terms of really helping healthcare companies find the best investors and the most appropriate capital markets listing venue solution. And in recent years, really a trail has been blazed by Renalytix in doing that and raising money here initially in London. And we've been very privileged to be part of that journey. So John, maybe I'll hand over to you next.
Great, thanks, Nick. I'm Jonathan Sachs, and I'm also a managing director with Stifel, based out of our New York office. And I've spent the last 5 years responsible for helping to build Stifel's international presence with US investors. So Nick and I collaborate on many of these dual listing opportunities. I've spent the last 20 years working for European and UK boutiques, always from the United States. And along this journey, I've gotten to spend a lot of time actually working with Randy Barron. So Randy, why don't I turn it over to you for your introduction?
So, hi, I'm Randy Barron. I run the international and global strategies for a firm called Pinnacle Associates. We manage $7 billion US, and we're stock pickers, meaning we don't short, we don't do derivatives, we just look for good ideas and hold them for a really long time. So in many senses, we're a kind of an ideal shareholder. As John mentions, I do a lot of UK investing. Actually, 55% of my book today, for reasons we could get into, are UK listed securities. Renalytix, that James will introduce in a second, is an example of that. We were Renalytix's first US investor, but increasingly, for reasons we're going to get into on this call, there's a lot of US-based managers and companies that realize it's a there's much less friction to go and list in the UK than the US. So I view it very much as kind of AAA baseball, which is as good players as the major leagues, but maybe a really kind of nice place to get your training wheels, et cetera. James, I'll turn it over to you.
James McCullough, and I'm CEO and founder of Renalytix. Spent several decades in oncology, precision medicine, really looking at earlier diagnosis of cancer, looking at rates of progression in cancer. And that's opened up a whole world in terms of treatment and changing outcomes in cancer. And actually, the precision medicine story in cancer has been incredibly successful. We now have cocktails of therapeutics to treat different types of cancers. We have ways of diagnosing cancer very early. Catching disease early is always the best way of changing successive outcome. And when we walked into the kidney disease space in really late 2017, we saw an opportunity to establish a new precision medicine diagnostic standard of care And we partnered with some fantastic clinical research and clinical teams at Joslin Diabetes Center and Mount Sinai Health System and others. And we began Renalytix, whose lead product, Kidney Intellex, is all about understanding disease progression early on in the chronic kidney disease cycle so that we can offer better treatments, clinical management strategies. And of course, now we have a whole new drug class called SGLT2 inhibitors, which are available if you understand who has kidney disease that is at risk of progressing and who's at risk for dialysis. We ended up listing originally on the London Stock Exchange AIM market in November of 2018. We did a follow-on round in July of 2019 when we received FDA breakthrough device designation. And as we started to commercialize, we moved on to the NASDAQ. Stifel played a critical role in that in July of 2020. So we've raised just about $140 million in total equity capital. And that was done all on a common stock basis. We can get into that, but a very clean capital structure. And we did that in just about 20 months. So it's been a success story. And I'm delighted that we're here in Utah. And for those of you who are thinking about raising capital in the UK from Utah, you have a massive advantage because the entire UK population is very envious of the skiing that we have in Utah. And you can wave that around as a door opener. And there are plenty of people willing to take that direct Delta flight from London Heathrow into Salt Lake City. And we can remind them that it's only 30 minutes to the mountains.
And speaking of that, James, I would ask Randy to mention the one most important factor about his background, which is he's in Utah.
This whole seminar, despite Dr. Moore's erudite accent, we're all just based in Utah. The world's coming here. Let's be honest. It's not a heliocentric universe. It's a Utah-centric, the beehive-centric universe that we're in.
Great.
Well, look,
Statement coming from a bunch of New Yorkers.
So speaking of New Yorkers, James, when I met you, you were a New York City resident. Renalytix had a market cap of 100 million pounds, and you and I literally pounded the pavement, going to meet with US investors and telling your story. For everyone's benefit here, can you maybe first explain, why did Renalytix decide to IPO on London's AIM growth market rather than the US in 2019 and even still today? This is a bit of a strategy that's sort of, not necessarily people's first thought. So if we could start there, I'd love to hear your view.
Yeah, the entrepreneurs on the phone know it's a matter of getting the money in the door because that starts the ball rolling. And in this case, the AIM was very attractive for a number of reasons. One was, we could define a fundraising process. So you had a start time, a finish time, you could structure it as long as the markets were willing. And that was a relief, having come off most of my career doing venture financing, where typically you undergo long diligence cycles and you run into venture committees, which can make or break a deal. It's a much different experience. Public offering experience on the AIM allows you to define and codify that process. You also end up with a much more distributed capital table. So I can't remember how many investors we had in our first round of financing. That was our first round of financing was when we did what's known as an admission or an IPO on the AIM. And you end up with a pretty comprehensive list of institutional shareholders that own a smaller piece of the company, as opposed to having just one or two venture groups in a syndicate that own a majority. And I found that very attractive as an experienced entrepreneur because we did have the ability to spread that capital table around. That also helps in follow-on financing rounds as well. The other major advantage was you end up with an all-common stock capital table. There's no preference. No tag-along, drag-alongs, all of the venture components, which I think have been overdone, that typically don't favor the entrepreneur. They favor the venture group. In the public market, we have a flat common stock round. You have a price, which is up on the screen, and that's your valuation. I found that incredibly attractive. And then, of course, the London market, the AIM market, is also attractive from a liability standpoint. On the NASDAQ, we pay a considerable amount for D&O insurance, shareholder lawsuits, and that type of legal risk liability is very different over in the UK. So you don't have to incur as much of an expense when you are addressing the public markets. And then, of course, finally, one of the other great features, especially for early stage or growth companies, is you only have to report every 6 months. So on the NASDAQ, it's quarterly reporting. On the AIM market, you get to do it every 6 months. That gives you an enormous amount of flexibility. It's actually very reassuring. And it does tend to focus the shareholders on the longer term aspects of the business growth. So very attractive. And then, of course, the UK markets also have government-run tax incentive structures, which make it easy for evergreen funds. They're called EISVTT funds, venture capital trusts, that are looking for emerging growth healthcare companies to invest in. So lots of reasons you want to do it as an alternative to a venture capital financing round.
So along those lines, how easily were UK investors able to understand your strategy coming in from the United States, trying to build this business? Did they get it right off the bat, or was there more of a longer educational process?
The UK mindset is definitely different. They are less into the vision and more into the fundamentals of the business, which created a discipline for me. I had to start talking about line of sight to revenue and how we were going to get there, and in a defined time period. So I think that was an advantage in the early growth startup phase. But we had other challenges as well. We had to beat the entire forest down when it came to U.S. diagnostic reimbursement, which is a lasagna plate of concepts and different parties that are very foreign to anybody who's outside of the United States. So we did spend a considerable amount of time talking about reimbursement. We made reimbursement a theme in Renalytix, because that has been the number one risk factor that I've faced over decades with diagnostic companies, is how do you get paid? Because if you don't get paid, what you have is a big research program, you don't have a business. But the law changed in 2018 on diagnostic reimbursement, and we were very much on the cutting edge. So we could paint a very clear path to how we would get paid for our lead diagnostic product against a very large total addressable market, 37 million Americans with chronic kidney disease. It's 850 million worldwide, and it's relatively untapped from a precision medicine diagnostic prognostic standpoint. And that resonated very well with the UK mindset of, okay, show us where can you get to the revenue. So it was funny, by the time we were done, our UK investment partners knew often more about US diagnostic reimbursement than some of the US investors that were taking a look. And I think now subsequently that we've spun off another company in kidney transplant, which came in, they've had a much easier time because the UK investor pool is now in a position to understand a US diagnostic reimbursement.
So Randy, let me ask you, we'd love to hear then your trajectory. I think earlier you said you're the first US investor in Renalytix. Talk about your experience with James, how you met, and how a US investor views a company like Renalytix listing in London, but then seeking US investment.
So I'm going to answer that in kind of a broader arc and maybe even give some numbers to some of the stuff James was talking about, because I think it's important. Often I get asked the question, why would a company, choose to list in the UK? And the best example I can give you is they don't have the quarterly filings or 10Qs. And James kind of talked broadly about lawyers, everything involved with kind of going public. But if you don't have 2 quarterly periods a year, then you can still release things. But if you don't have the same kind of level of detail, you're probably going to save 300, 500,000, maybe up to $1 million. And, if you're a company with less than 10 million in revenue, that ain't nothing, in the scheme of things. James, as he mentioned, the law changed in 2018. It continues to change. We were talking earlier about Medicare and how MSIT, but the kind of innovative technology rule, should be coming soon, which is going to essentially cut out a national coverage determination process, or at least cut the bureaucracy. that was always part of it. What that means is that others have come before you, to all of you on this call, and kind of done a lot of the heavy liftings. James mentioned Oblique, and I'm sure Nick will go into more detail on this, but Renalytix, I guess 2.5, 3 years old now in the public markets, had a spinoff last year, Verici. Well, Verici was the most successful IPO in London in all of last year. And you can make a very easy argument that Verici doesn't exist had not James gone and knocked on those doors and had those conversations. John, to your question as to why we like the UK, it comes down really simply. The world's a really big place, right? If you look at the ecosystem of US listed stocks, there's about 3,000, give or take, public companies. 20 years ago in the 1990s, that was 6,000 plus. Now there's a lot of reasons why that has dwindled. M&A, of course, a big part of it, but also the unicorns could get a lot of funding and didn't have a need to go public at the same trajectory. I would argue, given the reaction that the US market, this week excluded, of course, has had since kind of March of last year, that the US is ahead of everywhere else globally. So if I can find a place where I can pick up a phone and have a conversation with management that shares the same cultural mores and values that I do, that I can kind of hold accountable to what they're doing. It's a lot different, for example, than reading a Japanese P&L, which is 34% of the international benchmarks, but you don't get the level of transparency that you can get, especially when it's a US management team that's using this as a means to access, money, basically.
Great. So then that brings me back to you, James. You made your first round of investment and you found your early investors. Then how easy was it to raise follow-on capital in the UK market? And how did that path lead you to come back to the US with a NASDAQ listing?
Yeah, I think, we got lucky. It's a time and a place in kidney disease in particular, where we're seeing significant innovation. And there needs to be innovation because kidney disease is, using a huge amount of social healthcare cost, really focused on the back end of the disease, late stage kidney disease and kidney failure. So, it was very much a time and a place. And we were able to get FDA breakthrough device designation, which was a significant validation. We were able, with our Mount Sinai partnership, to make some significant progress. So we started putting down validation to the business model relatively quickly. And the market conditions were good. They were actually better when we went out in July of 2019 than when we did the admission, the initial IPO in November of 2018. So the follow-on market was quite receptive. And it came down to a basic equation. We said we were going to do things and we did them. And that started to create confidence, shareholder familiarity. Many of the folks also saw a transparency. I wanted to make sure we had a very open dialogue with the institutional shareholder community, obviously within legal bounds, but I did want to be accessible. It was fun to go to London. So I ended up walking around the street pre-pandemic, missed those days, heading to the pub after the roadshow. But we were able to turn around. We raised, I think, 28 or 29 million in the admission, and the follow-on round was just north of 17 million about 8 months later. So quite successful.
And John, John, let me just add to that real fast. You mentioned kind of how when you and James were hitting the street, this was a $100 million company, all this stuff. Well, today Renalytix is a $1 billion company. And there are certain thresholds that from the institutional perspective matter a lot more. So like James said, you lay out goals and milestones, you achieve them, that gets you kind of up the value chain. But once you kind of get to be $1 billion plus, the conversation changes a little bit and the domicile matters a lot less. I mean, once you're $1 billion, your liquidity is increased. There's a lot of it's a very virtuous cycle. There's a lot of things that come from being able to execute. So I do think that's an important milestone to put in there.
Thanks, Randy. That's really helpful, actually. In terms of being a public company in the UK and now public in the US as well, I mean, you see different investor attitudes? Have they changed towards you? What has that experience been from starting very small and now, what's the difference been as you've grown in size and stature?
Good question. It's a more complicated operation. We are dealing in two different securities environments, actually three different securities environments. The market abuse regulations of Europe, the UK securities law and the 34 Act. And sometimes they're not all completely synced up. So there are some subtleties around disclosure requirements, press releases. The UK has slightly different views on disclosure than the US does. These can all be reconciled with conversation. So you do have to stay on top of the different securities regimes, which is an extra complication. The NASDAQ it has a higher requirement. You do have to report quarterly. That does change your view. I actually find it very stimulating to report quarterly. I find it very focusing for me at this time. I would not have wanted to report quarterly in the beginning. So it is different, but the rules are the same. You have to manage expectations. You try to, overperform. You want to over deliver and under promise. If you stay true to some of the baseline values, then, you can operate in both environments and get used to it relatively quickly.
So, James, would you recommend that other U.S. companies follow this path? I know it worked for you, but what would you recommend to others?
You have to be the right company. You have to have the right management team affect. Reporting and communicating as a public company is different than operating under the venture environment. It does require a more intensive IR component. And when I talk about investor relations, it's more, you have a broader audience that you're speaking to on more of a consistent basis. And you have to watch how you manage expectations because you are, creating a public record with your press release, your statements, your quarterly reports, or in the case of the AIM, your half annual reports. But as long as you keep those things in mind, I think it's a wonderful route to go. And you can obviously, I believe, generate a lot more valuation, which ultimately holds up in the long term because it's not who invested in your last round privately and whatever the valuation calculation was. You have a price and you have a number of shares outstanding, and there it is. And that allows you to level set expectations in terms of what your company is worth. And it allows you to turn around and understand what the cost of capital is. It has always been confusing to me on the private side to really understand what the cost of capital is. It's difficult to understand where all of the mechanisms in a venture term sheet flow down through the capitalization table. So as an entrepreneur, it's difficult for me to understand what I really own because that's a complex calculation and there are many different factors. Public markets, you can see the price. The flip side is you are in the public markets, and if you make a misstep, the consequences can be very public and significant, but that's okay. You pick yourself up and you move along, and you take the right advice. You surround yourself with good outside parties that can help you manage that process. But yes, I'd highly recommend it to the right companies. It's a very clean way to raise money.
Well, look, at this point, why don't we ask then Nick, because you've been running points from a banking perspective with James, is Renalytix the only one? How can other companies follow this path, and how do you do this?
Yeah, it's thanks, John. Look, it's a great question, and I am sure there are people here that have joined us that are, thinking, well, sure, this is all well and fine, but surely, Renalytix is one of a kind, and this all sounds a little bit far-fetched, a US healthcare company listing on AIM, and could it be right for me? It all sounds a little crazy. Well, I'm delighted to be able to tell everybody that it's far from crazy. And there are three so far very successful healthcare companies out of the US listed on AIM. Stifel is actually house bank, or as it's referred to here in the UK market, corporate broker to all three of those companies. The other two are companies called MaxCyte, which is based out of Gaithersburg in Maryland, a life science tools business, and Polarian Imaging, which is a drug device combination company looking at xenon enhanced MR imaging for the lungs, based out of Research Triangle in North Carolina. And we've also actually raised money very successfully for those companies very recently. So we did a $55 million follow-on financing for MaxCyte in February, and we raised just under $40 million for Polarian Imaging in a follow-on offering in March. And actually, I've no banker presentation or commercial is complete without a few more slides. Let me just walk you through those case studies in a little bit more detail, and we'll start obviously with Renalytix being our local heroes from Utah. And you can really see this astonishing value creation story that James has unfolded with the team here, from IPOing with a sub $100 million market cap in late 2018. Obviously some really critical news flow here with the breakthrough designation coming in May, the CPT codes, follow-on financing, and then really absolutely hit our stride with a NASDAQ dual list, raising $85 million in the summer of last year. And with the recent news around MSIT, a strategic collaboration with AstraZeneca, a strategic partnership with DaVita, the company is now worth in excess of $1 billion. So I think by anybody's yardstick, even Randy Barron's, that is a good return on investment in a relatively short period. And just to give a couple of the other examples here, MaxCyte did a pretty small IPO actually about 5 years ago in 2016. Their market cap at IPO was only $43 million. And then really as the market has really got excited about cell and gene therapy, and particularly the companies, the life science tools companies that provide the services and products and tools there, that share price is re-rated in a pretty dramatic fashion. Back in the spring of last year, this was still a sub $150 million market cap company. It's now considerably in excess of $1 billion market cap. They have actually stated publicly that they're contemplating a NASDAQ dual listing as well, although they haven't given any further specific guidance on that. But clearly looking to follow in Renalytix footsteps. And then here, Polarian Imaging, that they've again been public for quite some years, but it's really only recently that the news flow has started to deliver. We jumped on board, became Polarian's bank at the end of last year, did a very successful fundraise for them here in March, raising £27 million, just under $40 million. And this sort of recent uptick here in the share price has in no small part been driven by the initiation of research coverage by our analysts here with a very fulsome price target. That they're saying that that they think the company's easily worth 135 pence a share. So very nice trajectory here as well. And what I won't give too much more color in a public forum, but I can certainly say that off the back of all of this success, we've got a number, I think at the last count, 4 or 5 US private companies that we're mandated to lead their IPOs in London. So I think people are really seeing this very much as a trend, and we get a ton of reverse inquiry. One of the beauties of the corporate broking model in the UK is my name and telephone number appears on the bottom of all of Renalytix and Maxight's and Polarian's press releases. So, you know, people that are watching this space and are intrigued can get hold of me pretty quickly. John, let me pause there and back to you.
Yeah, thanks very much, Nick.
Well, actually,
I
John,
guess-
as you do it, let me just jump one thing that I think Nick neglected to mention. In addition to the fact that he is the best in the business at this, the reason a company like Stifel has been doing so well for these US-based companies is that they have a sales force in the UK and in the US. So you need to understand, leaving this seminar, that it's not just kind of a pigeonholed UK thing. Like, you need to really approach this, that you want to have global distribution. I think that's a really important note to add.
Thanks, Randy. No, it's without an advertisement for Stifel. I think part of it is understanding, and I think James would appreciate this, knowing where the investors are located. So knowing and having that access to the key UK thought leaders, and also in the US. And since it is an audience from Utah, I can safely say that a number of our investors are based in Salt Lake, right? There's an increasing amount of institutional investors who are focused on international growth companies, you know, who are leading the charge, frankly, with posting terrific returns, being global citizens, smart investors, and obviously Randy adding you to that list now as well. So yeah, it's been an incredible journey getting to know Utah and seeing the growth from both a corporate perspective, but also an investor perspective as a magnet for capital. So, Kelvin, I don't know if you'd like to take questions at this point from the field, or we're happy to go in any direction you'd like.
Yeah, why don't we suggest that if people have questions, there's two ways we can do that. You can raise your hand and I can literally take you off of mute, allow you to talk and ask the questions directly, or you can type in questions into the Q&A function and we can pick them up there. That would be really important for you to ask the questions of these experts. While we have them here, well, there's one question just popped up, but while we're gathering some of those or raising hands, Nick, it was discussed earlier that companies in Utah, you know, small companies should not think that, oh, well, we're not a Renalytix. And so how does this really work for us? How would they know? Who do they engage with? If they really have an interest in pursuing this, who do they engage with?
Yeah, so I think the way we think about the sort of the phenotype, for want of a better word, of a company where this might be appropriate is, you know, I think Renalytix is a great example, right? Because it, you know, they had put up so much news flow, so much in the way of impressive developments, great team, great science, great product. They had a clear plan to move forward with some of the early commercial preparations, if you like, but needed money to do that. So, you know, I think, you know, the UK market, it's definitely not for sort of an earlier stage company that's maybe sort of more at the level of sort of scientific, early stage scientific development. I think, you know, most of the investors that support these offerings in the UK are actually generalist investors, although they spend, you know, a significant amount of their time, you know, anywhere between sort of a third and a half in the healthcare space. So, you know, they want to see that sort of later stage path to commercialization is coming forward. And, you know, I think just to give another example, you know, the Polarian fundraise in March was very well received because, you know, they've had a successful phase 3 trial. They're on file with the FDA. They've stated publicly they've got a PDUFA date, an approval date for their drug device combination in October this year. So, you know, that's pretty de-risked. And, you know, actually that transaction came about a little bit by reverse inquiry off a non-deal roadshow. Investors were calling us up after the meeting saying, look, we think this has got a very high probability of FDA approval. We think the company needs to have a stronger balance sheet now to make commercial preparations to really hit the ground running. So I think, it's that sort of degree of de-risking from a scientific, regulatory, clinical point of view. And people want to know that there is a commercial business there that's going to unfold in the sort of short to medium term, I would say.
So along those lines, one of our listeners has asked, does the company need to have a record of revenue and profit before considering a listing?
It's a great question. And actually in the diagnostics and life science tool space, that's something that really distinguishes AIM from NASDAQ. As a diagnostics or tools business listing on NASDAQ, you absolutely have to have that revenue and growth track record to demonstrate that the product sells, and so people can really base their financial model around a set of revenue and profit forecasts. Interestingly, the one diagnostics company that has IPO'd on NASDAQ in the last 10 years without having revenue is Renalytix. And we were really able to accelerate our plans to dual list with James and OJ and the team there last year, because we had done so much work with John Saxon and his team getting the company in front of US investors. And it's much easier to gain traction with US public market investors if you're already listed overseas versus being private in the US, in fact, oftentimes.
And Nick, just from the investor perspective, I can just add to that. Renalytix in a normal world would not have been public, right? It would have been a mezzanine. It would have been some sort of round. So for someone like me that only owns things that are public, in other words, has a certificate that I can sell to you or buy from you, I think that's pretty cool, right? I mean, there's some inefficiency that I can go in and say, all right, here's where I think there's a great potential, and it kind of gets vetted by a market on a daily basis. And I think that's, transparency is a good thing. Liquidity is a good thing. And so being out in the public and kind of taking your knocks when you deserve it and taking your accolades when you deserve it as well, like, that's a great moment.
So along those lines, does FDA approval status matter as much on an AIM listing? For instance, if they are working towards that approval, is that adequate? Or would you advise them, don't come to AIM until you actually have FDA clearance?
Well, I think Renalytix proves pretty comprehensively that you absolutely don't have to have FDA approval to do that IPO and follow on financing very successfully. Obviously, given the MSIT rule, which hopefully comes into force sooner rather than later, FDA approval has taken on even more significance, I think, for Renalytix. But clearly, if it's more of sort of a drug or a drug device combination like Polarian, where other than in academic centers, to roll it out into clinical use, you have to have FDA approval. People are very focused on that PDUFA date of the 5th of October this year. But, it absolutely did not prevent investors from, financing that company very, very well recently. People actually saw that, they were taking a call based on the very, very good phase 3 clinical trial data, that FDA approval was a low risk event. And this was really the last opportunity to build a meaningful position through the transaction that we conducted in advance of the inevitable significant value re-rating that approval will hopefully drive later in the year.
Now, Kelvin, I just want to say from a access standpoint, these questions are very good, but you've got to look at them in context. So it is not just an FDA approval or not just a revenue, et cetera. And I think where we were able to paint a very clear picture is there were a number of value drivers. And the point was we could paint a very clear picture to how we could become a market leader with strong barriers to entry. with proprietary components. And it was a timing issue, it was a time and a place. So kidney disease was ready for a transition. We happen to be sitting in the front of it. A lot of it is luck, but it's not a binary set of issues which give you access to the London market. It's more about the story holistically, the product, the market need, and the management team and how it's going to get there. So none of these are disqualifying.
Oh, to me, that's kind of an exciting element to the AIM Stock Exchange, is that holistic approach, because there aren't some of these qualification hurdles that they have to get over. It's really looking at the whole thing, which you would not expect from an approach that would be a public offering. One of our listeners asked about the timeline. If someone decided to call you today and you like their idea, what is the time frame for actually listing on the AIM? Is there an estimate? Is it depend? I mean, what's the time frame there?
Well, maybe I'll jump in on that. I mean, I think, any IPO process has two parts, right? Whether you're listing on NASDAQ or listing in the UK, the formal part of that process, from the kickoff meeting when you get around the table with your banker, your lawyers, the bank's lawyers, the auditors, that is somewhere between 4 and 6 months from the kickoff meeting to pricing of the IPO, whichever market you go in. But obviously, it's what you do in that pre-IPO phase in terms of, have you thought about getting the right board together? Are you going to meet the corporate governance guidelines? Have you got someone that can chair your audit committee? Some of those earlier stage preparatory work streams. I think, this is probably an appropriate moment to mention one of the really, really key advantages that AIM has over NASDAQ. And this is not about, saying bad things about NASDAQ and great things about AIM. It's very much about, just giving the perspectives on the different markets. I'm book running 9 IPOs at the moment, 4 in London and 5 on NASDAQ. So, I'm only interested in getting the right company to the right investors in the right listing venue. We can do either. But I think one of the really key advantages is the ability to meet institutional investors early in the process. So if you're doing a NASDAQ IPO, your bankers and lawyers won't be comfortable with you doing any test the water meetings until you're confidentially on file with the SEC. And that is going to cost you, the company, at least $500,000 in terms of legal and auditor expense just to get a document on file with the SEC before you can meet the first investor. Here in the yeah, it's not a cheap exercise, right, James? Just getting on file confidentially. Here in the UK, we'll obviously do quite a bit of diligence, both on the banking side and the research side, meeting a company, screening them, looking at the corporate presentation, doing initial diligence. But we have the ability to put companies way before a kickoff meeting, way before we've hired lawyers, in front of investors. And in fact, we're doing this with a couple of these US private companies right now. Randy kindly took a meeting with a company out of San Diego that we're doing test the water meetings with this week. We have a company actually out of DC that we will be calling Randy in a couple of weeks on to offer a meeting in late May or early June. And out of that exercise, you can get tangible feedback from 8, 10, 12 investors, and it gives you real visibility on demand and executability of a transaction. So I wouldn't think of it as a free look, because we do a bunch of work with the company to really screen out that, make sure we're working with the highest quality opportunities that have got the highest probability of success. But it is a free look in as much as you don't have to hire your lawyers and your auditors and write a full prospectus to have that first investor meeting.
Very important point, and it allows you also to warm up a little bit. There's always improvement. You always learn a huge amount, and you strengthen your own business plan when you go out on the road and do that type of a process. I'm glad you brought that up, Nick.
And so to that point, I assume that anyone listing on the AIM has to file something equivalent to an S1 registration statement, but you're saying that they can actually have discussions with institutional investors in the UK prior to filing that, whereas here you can't, but they do still have to file a document similar to an S1, is that?
Exactly correct. It's just the S1 over here is called the admission document or the IPO prospectus. But you produce it broadly to pretty much the same US standard. Stifel's obviously a very reputable bank. We do extensive diligence. We want to make sure that we're not saying anything that's, wrong or misleading to our investors. So, we will produce that document to a pretty high standard. But, lawyers here in the UK are actually, materially cheaper than US securities lawyers as well. So even though you're producing that document, it's not going to be as expensive as a NASDAQ IPO.
Nick, let me ask you a quick question. Do US-based companies need to do anything about changing their accounting, going from GAAP to IFRS or anything like that to meet the demands of the UK?
Not really, because typically for these companies, the revenue, the commercial opportunity is not yet coming through at the time of the AIM offering. So the financials are really not so important. I mean, people will focus on cash and cash burn. But it's not as if it's a full operating company, and there's a complete mix of practice. James and OJ and the Renalytix team actually converted to IFRS for the AIM IPO, and put a UK holding company on top of the group. But Maxite, for example, that's a Delaware Inc. that is listed here in London. You can list a Delaware, a US company here. They report in dollars, they report under US GAAP. So it's actually an extremely flexible market from that regard.
James, we have a question for you. You mentioned that it needs to be the right company and the right management team. So in your view, what characteristics make for the right company and the right management team?
Oh, throw me the hard ball, Kelvin. The right management team. You need to be comfortable with the IR process, the investor relations process. I think it's important. You can't hide. You need to engage. And that's a certain personality type. I think the management team has to have a number of functions and skill sets operating at a relatively high level. So in a private situation, for example, you don't need as a developed a finance function or a securities function. You have to be, certainly as a CEO or a senior executive manager, you have to be familiar with or willing to learn quickly how to manage multiple constituencies associated with the securities market, certain types of lawyers, IR, PR, et cetera, bankers. And these aren't things that you can't learn, but you do have to be open-minded and willing to crawl up the learning curve. So the depth of the management team has to be there. And when you do get into the admission process, it's a lot of work. And Nick and John will put you through the paces on the roadshow and the follow-up, and the investor questions can come fast and furious. Because you now have a much more distributed capital base as opposed to one or two venture or three venture groups that you're answering to. So you have to have that there. In terms of the company itself, I think Nick explained it very well. You've got to be able to paint a vision that has validating endpoints that you're willing to lay on the table, because those are the metrics to which you're going to be held accountable by the investor groups to how you're going to get to a revenue generating position if you aren't already. And as long as you manage those expectations well, then you should have a relatively straightforward ride of it. Where things start to go south, especially in the public market, is when you fall behind those expectations. And you're not going to hit every milestone. We didn't. But then we also got lucky that we crossed through a number of milestones we didn't think we would cross through for several years. So things balance out.
And Kelvin, if I could just add to that from the investor perspective, James didn't mention it. I check every one of those boxes. I agree. We need to have a good team and, ethics. You need to have some humility as well, which, from my experience here in Utah, is a lot easier to find here than in a lot of big markets. And the reason I say humility is when you have, and I don't know the number, James, I'd be curious how many people you had to go meet with to do your kind of various rounds. If you're meeting 100, 300, 500 people, whatever, inevitably you're going to rub someone the wrong way. And how do you handle that, right? Are you standoffish? Do you flow with, are you the rock or the water? So I do think that that's kind of a soft skill that matters.
James, it reminds me of the one breakfast meeting we had where the investor never showed up. And if you, I bet,
John, that was a great restaurant.
That was a great restaurant, but we had to eat by ourselves. And unfortunately, he missed out on somewhere between a 5x and 10x return for missing that breakfast, which was unfortunate. Randy, I've heard you say this many times in meetings, and I think that our audience would appreciate it. When not every stock chart goes from the bottom of the left to the top of the right. And we've done a good job of showing those, all of those victories. I think today,
all of ours do, John.
Yeah. Say this is a very cherry picking conversation.
That's right. So look, for the management teams who are on the call, when things don't go right, is it because of what exchange they're listed on? From your experience as an investor, when things don't go right, what happens, and how does that disappointment work through the system for you?
Well, I'll start with the end. We firebomb your house. No, I'm kidding. But I do think, there's, okay, Renalytix, right? Great example, really successful. I often get this question, oh, you're up 5x or whatever the number is, 8x. And it's not at all. I mean, James and I met, like he was saying before, and this is obviously dating us pre-COVID, in a really small rinky-dink office, and it was him and me just hashing things out. And I didn't know him, he didn't know me. This is years ago. But it's really easy. My business, and Nick didn't give his bio, but he's actually a doctor, right? So I kind of compare this to brain science. What I do for a living is not brain science, right? It's stressful, it's hard, but it's pretty easy to look at a sheet of paper and say, are you profitable? Do you have cash flow? Do you have the burn? All the things that matter. The question, John, that has kind of proven to be the most important, that you can only prove over time, is, are you a good person, right? Even a sociopath in the short run, if you ask that question, right? If I said to anyone, I said, Kelvin, are you a good person? Kelvin would say, I'm a great person, right? Like, it's just the nature of the answer. But the only way, not that Kelvin's a sociopath, to be clear, but the
that you know of.
Well, exactly. He hides it really well. But my point is, the only way that you get a real answer to that question, where the rubber meets the road, is with time. Do you execute on what you set out to do? And like James said, yeah, there were misses. Do you hide when those misses happen? If you're accountable and you show up and you can actually, blocking and tackling, that's what life is, just showing up and doing it. I think that is the fundamental thing. And you all on this call would be surprised. I meet hundreds of companies a year. You would be surprised with the amount of companies that just go dark when things don't go well. They hide, they put their head under the mattress, and kind of like that's an approach, I guess, but that's not an approach that's going to get you follow-on capital. Accountability matters.
So Nick, we just have a few minutes left. Let me ask two quick questions, and anybody in the group can respond to these. If a company has already got a table where they've raised money through different methods, whether it be angel rounds, VC capital, whatever, does that limit their potential for this opportunity? Can you address that? And at the same time, talk to us a little bit about the cost of a listing on AIM versus costs on NASDAQ.
Yeah, they're both great questions. I think that the cap table one is very simple, and it becomes quite binary quite quickly, because essentially what investors in these earlier stage pre-revenue companies in healthcare in London want to see is no debt, no funny instruments on the balance sheet, and a very completely clean capital structure with one class of common stock, or ordinary shares, as we'd call them over here in the UK. So, you know, that simply requires, you know, the current investors to collapse down into one class of common stock. And, you know, if they're not prepared to do that, then we can't do the IPO in London. You know, there are no situations where people have had sort of debt on the balance sheet or different classes of stock. And I think, you know, for management teams in particular, that can be a real attraction of doing this, right? You know, when several of the companies that we've discussed with today were thinking about this, you know, they were not ready for the NASDAQ market. So, you know, going public in the US was not an option. The other alternative was taking VC money in the US, and you know, that's always pretty structured. It probably comes with some control. It'll come with some liquidation preference. It may come with one or more board seats and some real sort of hands-on control. I think, you know, what you gain in return for collapsing down your capital structure to a clean balance sheet and one class of ordinary stock is, you know, full flexibility for the management team to run that business as an independent public company. So, and you know, that's obviously been hugely beneficial for Renalytix and MaxCyte and Polarium. And you know, obviously, if those investors are not prepared to do that, then it's a pretty short conversation. But if they want access to the London market, that's kind of the price of entry. And then, you know, just in terms of sort of the overall mechanics, you know, you're probably looking at you know, I don't know, a few £100,000 for the admission document, assuming there isn't, you know, anything overly onerous to do in terms of licensing or IP or breaking other things out. But, you know, you're probably looking at paying, you know, £250,000 to the company's lawyers. The one wrinkle in the UK process is over here, the company picks up the tab for the bank's expenses, including our lawyers. But typically our lawyers cost about £100,000 for an AIM IPO. And then, you know, because these deal sizes tend to be smaller, you know, of the IPOs I'm doing at the moment on AIM for US private companies, the smallest is targeting $25 million. The largest is targeting 50 to 60. So they're sort of broadly in that zone. You know, our fees here at Stifel are 6%. There's a corporate finance fee on top for some of our regulatory responsibilities that we owe to the exchange. So actually, the bank commissions are not hugely different from what you would be paying on NASDAQ. You know, NASDAQ IPO is 7%. We're 6% plus a bit. So you know, that doesn't that part of the equation doesn't shift a huge amount. But, you know, dramatically cheaper in terms of lawyers and auditors versus NASDAQ. Kelvin, you're on mute.
Does anybody have any final comments before we end the webinar today? All right. We really, really appreciate it. I got a text from one of the participants in the conference who said, "This has been a fantastic Zoom session. We all learned so much, a real value-added event." So you all did your jobs.
Well, that's great. That sounds like 5 stars on an Uber rating to me, Kelvin.
Yeah, that's what it is. So we appreciate all of you being on the call. We will be posting our recording of this on our website. So we had probably 6 of the people who signed up who couldn't make it, and we'll make sure they have access. And there were many others who indicated they wanted to be on that couldn't. And we'll
perfect.
And if anyone has questions beyond this, feel free to contact us. We'll put you in touch with the right people at Stifel or James or Randy or whoever you need to talk to. So
yeah,
we appreciate you being on the call.
Just to emphasize, we'd be delighted to do follow-up on a sort of one-on-one basis with, you know, if there are companies out there that think they meet the sort of broad phenotype that we've discussed, that need to raise $20 to $60 million, are not ready for a NASDAQ IPO, we would love to hear from you.
That is music to many of our companies' ears. So we hope that we'll have further follow-up. We appreciate everybody being on the call today. Thank you very much.
Thank you very much indeed.
Okay.
Why did the whole year of 2020